What is an ETF, or Exchange Traded Fund? An ETF is a basket of securities that can be bought or sold through a brokerage firm on a stock exchange. ETFs are offered on a variety of asset classes, from traditional investments like stock and bonds to so-called alternative assets like commodities, currencies, or managed futures. They are like mutual funds, but with one big difference. Exchange-traded funds can be traded through the day, as often as you like, whereas traditional mutual funds can only be bought at the close of the New York Stock Exchange. ETFs are appealing to both small and large investors because they allow them to short markets, gain leverage, and avoid short-term capital gains taxes. ETFs began trading in 1993. Now there are over 5,000 ETFs available around the world, with $3 trillion in assets under management. Let's look at a few pros and cons for this type of investment. Some things exchange-traded funds do well include they can be bought and sold just like common stock through a brokerage account. They can combine the range of a diversified portfolio with the simplicity of trading a single stock. ETFs that track an index like the S&P 500 or NASDAQ are passive investments, and therefore annual management fees are usually very low. For those types of passive investments, they also offer tax efficiency by minimizing capital gains taxes. Conversely, a short-term gain obtained from trading an ETF will be taxed at a higher rate than a short-term gain obtained from trading futures. While some ETFs have a very narrow bid-offer spreads, there are many ETFs that have wide bid-offer spreads and very little liquidity. Some exchange trade funds track their underlying index very closely, while others may be less consistent and display tracking errors. And finally, ETFs don't trade 24 hours a day like futures contracts do. To learn more about how ETFs compare to futures contracts, please watch our Futures versus ETFs video.